Why is it that when discussing the role of guaranteed income within a retirement plan, Social Security and pensions seem like good things, but annuities seem largely like scandalous things? Might it be the high commissions and high-pressure sales tactics? But what if you could get rid of those? Today we welcome someone who has done just that, David Lau of DPL Financial Partners. David helps us explore the wide world of annuities, what they are, what they do, and how fiduciary advisors are using them today. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show. Welcome to the Retirement Lifestyle Show. I'm here today with one of our co-hosts, as we usually are. That's Adrian Nicholson. I'm Erik Olson. Our other co-host couldn't make it today unexpectedly. Roshan will be back next week. Too bad for you, Roshan, because you're going to miss out on an awesome conversation that we're scheduled to have today with David Lau. David is a serial innovator and a fintech guy who's been in the industry in one fashion or another, one role or another, launching innovations that the industry has long needed. I remember 10 years ago, first encountering one of the tools that David innovated with, a commission-free, no-load variable annuity, and I thought, wow, this is awesome that the industry is going this way. I had no idea who was the genesis behind that idea or the driver behind that idea, but we get to have him as a guest on the show today. So today, David, in his role now, is the head of DPL Financial Partners, which has innovated still again in the space, offering a variety of commission-free annuity and insurance products in a setting or in an industry that is, for the most part, offering clients very little choice in that category, at least has been until David and his team started to innovate here and both teach advisors like Roshan, Adrian, and me how these tools can be used, as well as teaching insurance companies that indeed there is a market for these sorts of things, and they should start to develop those. So we're extremely grateful, not just for you being on the show here with us today, David, but also for the work that you've done, and honestly, the contribution that you've made to, I think, a more fiduciary approach to serving clients. So welcome.
Thanks, Erik. Good to see you too, Adrian. Look forward to the conversation.
All right.
Yeah, we're really always happy to have a guest on this show, David, and I'm really looking forward to this conversation. I'm sure our listeners are going to get a lot of really good content and some good expertise here, so I'm ready to go.
Amen.
Terrific.
So I want to just say to our listeners, we have not, in the 2+ years that we've been recording this, done a dedicated episode to the subject of annuities. We've touched on a variety of insurance products in the past, explain how they work, but haven't really done a deep dive on annuities. And so today is a bit of a true confessions or mea culpa for you, our audience, to understand perhaps why that is. So and it's connected directly to the question of commissions. So as you, our listeners, know, we have shaped our practices in a way that are fiduciary practices, meaning we're not looking to come in under the guise of saying we're going to do something in your best interest, but in our back pocket we have a tool that we can whip out, persuade you to purchase, and suddenly we can go make a boat payment. So instead, what we have done is to say, well, since there doesn't seem like there's a clear path toward those sorts of tools that historically have carried these commissions, we just won't talk about them at all, or at least not much. And that really, in some ways, is a disservice to you, our listeners, and I would argue in some ways also a disservice to our clients. So it's a relief to be able to find now a rapidly developing suite of tools that David and his team have identified and assembled and coaxed out of various insurance companies, both on the annuity and the insurance side, to put us in a position where we can start to put these tools into our financial planning software and our other modeling tools and find whether they could make a good contribution to your outcomes, clients and listeners, without having this sort of concern that we're going to now have to explain to you why it is that we're bringing in something that has a commission built into it. So I think I'm done with the mea culpa for right now, and we could proceed on to talk about these tools themselves. So David, actually, before we talk about the tools, would you just say a few more words about kind of your path? How is it that you're leading DPL, and how is it that your career got here?
Yeah, well, I've had a long, thanks for that, intro, Erik, you set some good context for what we'll talk about. But yeah, I've had a long career in financial services. I'm getting to be old. I've been around financial services since the mid 90s. And really that the experience I had, my first experience in financial services, is really what has informed my whole career. I didn't start out in financial services, but in the mid 90s, I joined a bank that was a direct bank. We were just getting started. It was a direct bank, and the notion was branches are just expensive. They just are high overhead. They're just add cost to the consumer. And you're selling commodity products. So can we build a direct bank, eliminating the branches, and provide better value products to the customer by eliminating what is effectively really expensive distribution in the form of a branch? And then, kind of fortunately, as we were getting this bank launched and we were, a year or so into it, the internet came along, and we basically had already an internet model effectively, as a bank. So we became the first internet bank in the country. It was a bank called Telebank, and it was Telebank because it was named pre-internet. Otherwise, it would have been Internet Bank or eBank or something like that. But the notion was, again, deliver better consumer value by eliminating cost and overhead from the manufacturer's point of view, which was the bank. So we were, hugely successful, in building the bank. We grew it from 50 million in assets when we launched, from a bank that we had purchased to 16 billion in about 5 years.
Wow.
So, massive, huge growth. And it spoke to, people need better value from their, product providers, in financial services. So after that, we sold the bank to E-Trade, became E-Trade Bank. I spent a little time there, and then ultimately, left to kind of consult for companies literally around the globe on how to build internet banks. And did that with Shinsei Bank in Tokyo, which was the largest bank in the world at the time. Merrill Lynch, helped launch their banking, products, and a number of others. Before then rejoining one of the founders, or the founder, the primary founder of the bank, a guy named David Smilo, who's here on my board now at DPL, where he founded an insurance company called Jefferson National with the same notion. Can we eliminate the expensive distribution in order to provide better products? And in insurance, it's not branches, it's commissions. And also, by the way, wholesaling, right? So, if, for people who don't understand what that means, is one, when you're getting traditionally a life insurance product or an annuity product, there's the broker who's selling you, or agent who's selling you the policy. They're getting a very hefty commission on that product, or historically they have. And then there's the wholesaler who works for the insurance carrier, who's talking to that person, convincing them to sell their product. And by the way, one of the best ways of doing that is giving them a really big commission. So and that commission, by the way, is paid, and this is a common misunderstanding, based on the way they often get presented to clients. That commission is coming from the client. It's not coming directly from the client immediately. The insurance carrier is paying the agent that commission, but then the price of the product gets to be really expensive. So the insurance company starts taking back that commission little by little, year after year after year. And that's why they lock you up into a policy, so that they can make sure they get their money back from the commission. But, the client is paying a very expensive price. So when you looked at, kind of driving change in the insurance world, it's, okay, number one, we got to get rid of the commission. Everything else in the world is going to no load, mutual funds. You've got ETFs, retirement plans. Everything in the world is moving to no load, meaning commission free, and driving costs down across financial services everywhere except insurance. Insurance is living in this bubble that is, still high price, no cost comparisons, commission driven, and that just needs to change. So at the bank, we built a pretty successful company at Jefferson National. As you were describing, Erik, we innovated the annuity by saying, well, hey, let's just bring out a flat fee annuity. Why does it need to be a basis point charge or percentage of your assets? Costs us the same to administer the policy. Why do we need to vary it based on the size of the account? So we brought out a $20 a month flat fee product, and we had a lot of good success with it, but it didn't have the effect that the bank had. So when we launched the bank, we drove change throughout the banking industry. Now every Bank of America, Citibank had to start offering internet services. They had to start offering bill pay. They had to start matching the things that we were bringing to the table. That didn't happen at Jefferson National. What happened was insurance carriers started launching products just like ours because they thought, okay, this is, we'll do a very simple product just like theirs, rather than driving change throughout all the product sets, which is what I'd hoped for. And so after doing that and building that company for about a decade, I said, this isn't moving the needle for consumers like I want it to. So the better way to do this will be to create an independent company that effectively mirrors what Charles Schwab did for mutual funds back in the 80s. And you create a marketplace of no load, commission-free insurance products. And that has two really important benefits. Number one, you're driving costs down dramatically, 80% ish, right, on products. And number two, it allows people like you guys who are fiduciaries to start using the products because they're now not commissioned. So the customer is getting a better result in two meaningful ways. They're getting a far better priced product, and they're getting it implemented from somebody who's looking after their best interest, not somebody who's trying to maximize their commission.
Great.
Yeah, that's really great. And you brought up like two really great concepts that I like when you're kind of talking about like how you ended up where you are today, where you kind of looked at this kind of commission standard that's kind of been in place for so long and really looked at that and say, hey, what can we do to really like change? What can we really do here to kind of make this better, to kind of look for like a new marketplace and really just bring, like you said, the best value to the customer at the end of the day by lowering costs. And I also liked in your kind of story as well, how you kind of use technology, you kind of leveraged it to make it even better to implement it. So I really like how you're kind of not in the status quo, kind of looking at certain systems in place and seeing how you can make it better and move forward for the client. I think it's really great.
Yeah, and that does bring up a really important point, Adrian. So part of what enables us to do what we do is technology, right? So you've got to, we look at technology as replacing the wholesaler, right? So in the banking, model, okay, get rid of branches. Okay, that's easy. Now what's your storefront? It's got to be technology. In insurance, we get rid of the commission. Okay, but now how do we get to the market with the products? And, and doing that in the traditional way is, paying a wholesaler. And again, this is the person who represents the insurance company, going door to door, talking to financial advisors, taking them out to expensive dinners, maybe to ball games, all that stuff, which is a really expensive way, again, of distributing, which also, by the way, gets built into the cost of the product for the customer. So if you can deliver that through technology, you've got a couple of other advantages. One, you've got cost advantage and scale advantage, of doing that. But two, you also, which is what, the part of it that I really love, is you bring in comparison and you bring in price comparisons. When people think of annuities, nobody other than like simple annuities like SPIAs, which are, immediate income annuities, or MIGAs, which are kind of like CDs where it's just a plain rate, and they're super easy to compare. How do you compare a variable annuity? How do you compare fixed index annuities, which are the two most popular types? They're super hard. Nobody does it. It's just you're sold a product based on what the salesman is trying to sell you, and they're built with things that sound very sellable. We're going to have great growth and no downside and all this, nonsense. When really what you want to be able to do is compare product to product. Let's find the best product. And that's what you do with every other product that you're working with for your clients, right? I mean, you don't just pick a mutual fund based on the wholesaler who shows up and says, hey, this is a great fund. You've got tools to evaluate, right? So we do the same thing. So our technology, some people have likened it like to Morningstar's, fund analyzer, that we bring technology so we can normalize looking at annuities. And you don't need to be an annuity expert to find the best product for your client. You just need to know what you want to deliver for the client. And then we bring technology to compare all the products in the market and say, this is the best one for your goal. And I think that's hugely important as well, because before something like that, carriers, the only thing they really cared about competing on were commissions and, bells and whistles, not value.
It's interesting. I wasn't thinking that we would necessarily talk about tools for evaluating this, but it makes sense. On your website, I noticed there and played with one of the tools there actually, which is allowing you to go in and say, okay, here's the parameters for this particular client. Is it single? Are the clients married? What's the age of the younger, male or female? Okay, how much are they looking for in income, or how much do they have that they want to allocate to this sort of a solution? Now, here are the various tools. I thought it was interesting. It was tool agnostic because it brought back, in some cases, as what you called a SPIA for our listeners. That's a single premium immediate annuity, SPIA or SPIA, and it compared those with a variety of other deferred annuities, just showing which is going to provide the best result for this client if they're looking for income or what. So thank you for the set of tools. I know I'm going to be going back and using that now again and again, and then trying to find things that and the parameters of those in the current state of the market, because interest rates are going to change some of those outcomes a little bit, et cetera, but then to be able to bring that into a financial plan. So did you want to respond to that?
It's important, again, just to focus on outcomes, right? We don't care about product, it's outcome. What are you looking to deliver? So I don't, care whether it's a variable annuity or a SPIA or a fixed indexed annuity, and the client doesn't. They care about the result and the outcome. And so that's why we look across all product types. You just tell us what you're looking to do. We'll find the best product to do it.
So for our listeners, I want to also just identify a kind of framework that I think our conversation is going to follow from this point till David has to leave, which is to first just identify some basics of annuities, then talk about some of their properties and features. Then third, there are criticisms, and we've touched on some of those, so we don't necessarily need to go all that much deeper in those, but there are indeed responses to the critics. And then I'd really love to spend most of the remaining time actually on the various applications for these various tools. So if you don't mind, David, I'm going to actually take a quick stab at this, and then if I completely muff it, you can correct me, and we can even delete things from the recording. We're in good shape there.
Great.
But listeners, I think the simple way to understand annuities, if your head is already swimming thinking, I don't really understand these, there are many, many types of them, but I think they reduce in the simplest terms to the following two choices. Number one, do I want to forfeit my cash, and I will not have control over that cash at any point in the future, and in exchange and trade that cash for some guaranteed income stream for some period of time, starting at a point in time I decide. It can be now that I want it now. I can have it kick in when I'm 80 or 85, you name it, or I can have it last my whole life. I can have it last a few years. But the point is that you're forfeiting that cash. The other form is where you don't forfeit that cash, although it may be that it depletes over time, but these are normally referred to as deferred annuities, even though I referenced the concept of deferring the inception of income in talking about quote unquote immediate annuities. But in this case too, you have the choice of when do you start that income. It could be now, it could be later. And there's then many different manifestations and permutations of those different tools, but that's the essential thing. It's an approach of trading cash for a guaranteed or using cash to obtain commonly an income stream or tax deferral. I don't know that there's much more to say about that, but David, you think, Erik, you're completely missing it, bro. Here's what this really looks like.
No, that's completely fair. I think about it before, giving a framework for how I think about it, in terms of the products. Like you said, there's lots of products, and so, lots of different product types. So one of the things is, people sometimes hear annuities and they're like, oh, annuities, controversial product. And the thing is, they're not controversial among people who don't have a financial incentive around them, right? So academics who study retirement, Nobel Prize winners, retirement researchers, they're universally supported for retirement income. Universally. You can't find a legitimate academic who doesn't like the annuity structure. And an annuity structure has been around since the Roman times, right? And so it's a great device, and it's a great structure, for pooling risk and creating, lifetime income. It's a really solid structure. The controversy and problems come with commissions. So, commissions, as I say, are the root of all evil in, you could probably say it in anything, right? But it's certainly in annuities. Commissions are a bad structure. They drive up pricing. They create this, poor incentives that are not aligned with the customer's interest. They create the need for bells and whistles to differentiate and create sales mechanisms. So there's all kinds of bad that comes from the commission. You eliminate the commission, you get down to a fundamental structure that is very valuable to a financial advisor and to a client. And so now to get to the way, I think about it is, so the SPIA, as we keep talking about, is the immediate income annuity, single premium immediate income. That means basically, as you described, you're taking some assets and you're buying an income stream. That's the way to, kind of think about it. You've turned, and right now is actually a really good time to do that. We've had a, 13, 14 year bull market. Take some of the chips off the table, as they say, and if you're approaching retirement, let's buy income with some of the gains. It's a great thing to do. However, behaviorally, it's a challenging product. Lots of clients don't like the notion of, I've turned over these assets to the carrier. What if I get hit by the proverbial bus tomorrow? Do I lose all that money? That's the concern. So they're not very popular products, with clients, and financial advisors, frankly, don't also like losing control, of the assets so they can be reactive to client needs. So really good products in terms of the value, tough behaviorally, both for advisor and client. So the most popular products are variable annuities and fixed indexed annuities. And the way to think about those is, before taking income, you're going to accumulate. Your assets are going to grow. How would you like them to grow? In a variable product, hence the name, you're going to invest in funds. Just like mutual funds, you're going to invest in funds, you're going to be in the market. Your assets can go up and down, based on the market performance. So you've got variable accumulation. The benefit of the annuity through that variable accumulation is you also get tax deferral, which is a valuable component of, any account. Let's not pay taxes. Let's defer it. You can get, compounded growth on that. That's terrific. With a fixed index, you're growing more like a bond. You're growing, not in a variable component. You've got a downside protection. You can't lose assets due to market performance. They offer a fixed rate, in the account. Our products right now are, 2.5%, 3%, maybe 3+% in the fixed account. And then you also have what they call indices, that you can invest in, the S&P. And the way that kind of works is, you get a downside of 0, so you can't lose money, and then you get a limited upside. Maybe it's 5-6%, in the S&P. So it's a very safe product, and you're taking risk off the table, but, don't let anyone tell you you're investing in the S&P and you're going to get no downside with, all the upside. It's going to perform more like traditional fixed income. You're going to get, 3-ish% returns. And then ultimately with either of those products where they get really powerful, you get that benefit of tax deferred growth. And then when you turn on income, you now get income for life. And the advantage of doing it through those products is the assets remain accessible until they've been depleted by the payouts. Meaning you can start taking income, and if for some reason you need whatever assets you haven't been paid out, you can get them. It's there. You don't turn them over to the carrier like you do with, an immediate annuity. And then the further benefit is after your assets have all been paid out, the insurance carrier, this is the insurance part, will continue paying you for life. And that is a really valuable, benefit, for a financial plan in many different regards.
Yeah, that's a really great point that you brought up. And I kind of like how you said, like, some of the previous podcasts we had, we kind of talked about kind of like alternatives to bonds. Like bonds sometimes are losing people money. Given the current interest rate environment, it's a conversation our clients are having more and more where they're looking for other areas of income. Since we're on the topic of annuities today, kind of like given like the outlook where interest rates are going and what people are talking about with them, how do you think annuities are going to really respond in the future with this given interest rate environment?
Yeah, interest rates affect everybody. So annuities, in higher interest rate environments, had higher payout rates, offered higher caps and interest rates and stuff like that. But actually in low interest rate environments is where annuities really shine relative to traditional fixed income. So, because annuities have risk pooling, I quickly mentioned that earlier, meaning, the carrier is taking all these lives, they're, building actuarial models around how long people will live. And then they're in the payout rate that is given to the client, meaning what percentage of your assets are they going to pay you each month, is factored in this, what they call a mortality credit. So you're going to get paid a little bit above the interest rate because of this risk pooling. And that risk pooling amount doesn't change in a low interest rate environment, right? That stays steady. Regardless, it doesn't change. The interest rate environment doesn't have effect, on mortality. Though the interest rate, so in a low interest rate environment like today, say, you're getting 1.5 on 10-year treasuries, that risk pooling mechanism in the mortality credit is still going to give you an additional two points on your payout rate. In a traditional interest rate environment where you might be getting 5%, you're still getting the 2%. So relatively, the value of the annuity is greater in a low interest rate environment. So that's one aspect, and that people have common misperception about. But the other thing, as we talk about with many advisors is, as you were mentioning, Adrian, fixed income is painful right now, right? I mean, and I say we're in a low interest rate era. It's not even an environment anymore. We've been in it for 14 years and it's getting worse, right? So, at what point do we say this is the reality that we're living with, not a point in time? And I think it's a reality at this point. And if you look at other industrialized countries, you'd come to the same conclusion. We're David Blanchett, who's a retirement researcher, he's a good buddy, and we do a lot of stuff together, in terms of podcasts and webinars. He's got a slide that shows you interest rates have been declining for like 3,000 years. There's no trend that says interest rates are going up. And so when you're looking at that, you have to look for alternatives. And so what we see, which I find really troubling, and I think it gets masked by the fact that we're in this prolonged bull market, is two things. And we have it in our own data. We've got it anecdotally, and you've got it throughout industry studies from BlackRock and Schwab and all kinds of people. The equity portfolios are increasing. So in your traditional, portfolio, somebody might be a 60-40. They're creeping up to 80-20 because the equity markets have been performing. The fixed income markets haven't. Clients are like, why do I want to go into a bond at 1% when the market's just, this raging bull? There, people lose perspective that there is actual risk in the market, particularly when we have a pandemic and it bounces back in like 60 days. So you have this dynamic that equities have been doing well. People don't want to move out of equities. Fixed income is problematic. So you get that dimension of risk being built into portfolios. The other thing is you start looking as a financial advisor, what alternatives do I have to the trusty old bond, right? The trusty old, treasury, or the, AAA corporate, which don't yield very much and negative relative to inflation these days. What alternatives are there? And basically it's getting more risk. It's bringing more risk into the table. So clients are getting risk on both sides of their portfolio. They're getting more risk because they're heavier, allocated to equities. They're having riskier fixed income. And that's why I think, again, I get so passionate about what we're doing, because we're giving advisors like you guys a whole new tool. And a safe one. In insurance carriers, these are very safe investments. I'm not saying they're risk free, but these are safe investments. It gives you a whole new tool, outside your investment world, to help deliver better outcomes for your client.
So, David, we're talking about these various features of annuities, and you've mentioned now a couple of times risk pooling and mortality credit. So I want to take a shot at explaining this for our listeners. So listeners, imagine that you and 9 of your neighbors, you're all 60 years old, and you all have a life expectancy, at least according to broad population tables, let's say, of 25 years from that stage. Maybe it's 30. We'll just use 25 for this purpose. You might all go buy a bunch of bonds for a portion of your income and figure, okay, I'm probably going to live around 25 years. I'm going to, between the interest that's paid off of those and the underlying principal, I'm going to make that so that it taps out just around that 25th year. Or you might say, no, that's foolish, because there's some group of us that's going to live longer than that. Maybe we should make it stretch out until we're our mid-90s or 100. Well, all right, so you do that. And just think about that for a minute. You're 60, you're going to make it last till you're 100. That means that you get to take about 2.5% of that per year, plus whatever interest it might generate on average over those years. Well, that's not necessarily getting a killer return on your portfolio if you can take that low a withdrawal rate from that portfolio. But you might say, instead, with your 9 neighbors, let's make a pact. Let's instead agree that we will, as a group, insure one another, because we know on average that we probably will live till 85. That's 25 years. Now we can take 4% per year, plus a little bit of that interest, instead of a mere 2.5. And you may say, well, 4 isn't that different from 2. On $1 million, it is. That's $15,000 a year more that you get to spend. What happens there, though, is that, granted, one of you is going to pass away at 64, another at 68, another at 72 and 76 and 80, et cetera, and you won't draw on that any longer, on that pool that the 10 of you put together. And so now those people that live out to that age 92, 96, and 100 have resources that will allow them to continue to spend at that 4% plus a little bit of interest, and make it all the way to the finish line without having to worry about it. That's what this is that the longer life people are winning the or are obtaining at least the benefit of some of those people having essentially subsidized their future. And do the people who passed away at 64 and 68 necessarily care? Well, maybe their kids care a little bit, but they don't care, because they're not here to care anymore. So that's the principle of pooling the risk of uneven life expectancies, and then allowing the longer life people to have the confidence that they can continue to have a better lifestyle than they otherwise would have if they were, every single one of them, trying to hedge against the risk that they'd all live till 100.
That's right. So that's, for financial advisors who, say, oh, I can do what an annuity can do. I can manage money like the insurance carrier. Maybe, but you also can't pool risk, right? And that's really the value you're getting there. And so there's a couple of things that, people, should realize. Number one, probably for your clients, they're likely to be in the better part of that risk spectrum. The wealthier, healthier set, tend to live longer. Number one. And number two is, life expectancy, particularly again for the wealthier, healthier, continues to expand. And MIT Age Lab, they'll say right now, you should expect that you will spend a third of your life in retirement. Think about that. And by the way, you're going to self-fund it. Primarily. I mean, you're going to have Social Security, hopefully at the same levels as it is today, maybe with reduced benefits, but you're going to have to live off your savings, for 30, 35, maybe 40 years. So that is a tremendously long period of time. It's a difficult burden. It's a psychological problem for clients who fear that. So there's a number of things. I'll get to that in just a second. But just on an easy way to quantify what risk pooling means, let's bring it home. We talk about this. Here's how you risk pool. Here's what it means. There's more mortality credits. Well, and annuities do better in a low interest rate environment. Well, to Erik, to your example, if you're looking to fund, say, $50,000 of income for 30 years, if you're going to look to today's fixed income market, it's going to cost you, let's say, $1.1 million, $1.2 million in assets to fund that income need for those 30 years. So you're going to have to dedicate $1.2 million in fixed income to do that. You can fund that same income need with an annuity for $600,000 or $700,000, right? That's a tremendous advantage. So when you're looking at the portfolio, for a client, you've got these underperforming fixed income assets. So what can you do? You look for options, and annuity is a really powerful option today. And that's what retirement researchers will tell you. Wade Fowles, David Blanchett's. Annuities are about 40 to 45% more efficient in today's interest rate environment at generating income. So why wouldn't you do it? The other benefit to it is that now you've got surplus. Instead of the $1.2 million, you only use $700,000. You've got $500,000 of surplus, which can now be invested in something that can actually grow, right? So, and you're going to do it for 30 years, 35 years. That $500,000 is going to turn into $3-4 million, depending on what kind of return you get on it. It is a really, really meaningful thing. And I think, it gets underplayed. I talk about this all the time. Commission-free annuities are the most important financial product innovation since the ETF. I mean, it's so powerful, what these products can bring to a portfolio. The other aspect I'll bring up is relative to this psychological notion. There's plenty of academic research again which shows that people who have annuities live happier retirements. There's less worry. You don't have to worry, the market's up today, the market's down, what's going on with my income. You don't have to worry. You get your income needs met, and they're met for life. So typically the way we're talking to, advisors about working with their clients is let's put it into a structure your client can really appreciate, which is let's look at your retirement and let's define through your financial planning, what are your essential expenses? What can you not live without? You have to have home. You've got to have health care. You got to eat. You got to have, for some people like me, you got to be able to golf, or whatever. You got to be able to go on vacation. Let's put some of those things into your essential needs. Whatever you deem as essential, let's cover essential stuff with guaranteed income. Social Security, if you happen to be lucky enough to have a pension, let's fill the gap with an annuity. And so clients can really appreciate that. Okay, I get it. I can't do without this stuff. Let's guarantee it. Then for variable things, your legacy, how much you're going to pass on to your kids, those, vacations and other things that you might want to do in retirement. Let's fund those with something that's variable. Equities, the market, right? Makes total sense. So, that's a great way, for clients to get comfortable into their retirement. That's a framework, that anybody can understand. The things that I have to have, let me live with the peace of mind that those are taken care of. The things that can be variable, let me, go for upside in the market.
It's interesting. I have a client who he's 70, she's 74. He's just now finally retiring, and they've done very, very well. But he's also she more aggressive, doesn't see the need for doing anything with a guarantee. He's, I would say, moderate conservative and nervously moderate conservative in his allocation. So I proposed to them that they take a pretty substantial share of their assets and they convert those in, and showed them that if they then, by covering all the fixed needs, would take the rest of the portfolio and invest it fully aggressively, that they'd wind up with, assuming of course it varies by how long they live, but they'd wind up with essentially the same legacy, which is very important to them, as in the first case. And, so it is interesting. I think the more conservative an investor is, the more this seems to me at least to make sense to cover, as you have said, to cover the essential parts of your spending with that guarantee, so that you don't have to freak out about allowing the rest of your portfolio to be very growth pursuing.
Yeah, I mean, you can see it actually in both directions. Some people who are very aggressive can say, okay, you're telling me I can fund this basic income need more efficiently with less assets. That gives me more money to go out into the market with, and try to, get upside with. So, you see that working in both directions. One of the other things that, annuities and guaranteed income do for clients in retirement, particularly those conservative clients who worry about outliving their money. It gives them, what researchers call a license to spend. One of the biggest problems, you read about it all the time, for retirees in America, is they don't spend enough in retirement because they're worried about running out of money. So particularly early in retirement, you're afraid of withdrawing too much because you might, run out of money later in life. When you've got those essential needs covered, you don't worry so much about taking that vacation you always dreamed about and enjoying your retirement. You don't worry about helping, your grandson with their down payment on their first house, whatever it might be. You feel more free to utilize your assets because you know that your essential needs are covered.
So I know that some of our listeners, for a variety of reasons, come with understandable skepticism about this, and we've addressed some of that, and it has a large part to do with some of the sales practices and some of the fees that have been built traditionally into these sorts of products. Are there, for some clients, and I think I know your answer to this, but at least I'll pose it so that if they were sitting here, they could be posing it too. Are there instances in which you'd say that even under the assumption of a commission-free structure, there might be the temptation for some people to overprescribe these?
Yeah. I mean, that's, again, for me, part of the big value in what we're doing is working with people like you who are fiduciaries. So who, wouldn't necessarily have any reason to overprescribe. And that's the benefit, right? With the commission, there's a high incentive to overprescribe, right? There's, I get paid more. The more you buy, the more I get paid. So you've got that, kind of incentive to do that. That's the value of, no load. Whether it's annuities or mutual funds or anything else, you don't have any incentive to do any more than you think is the best thing. Right. I mean, you want to deliver, the best outcome for your client, and there's no financial incentive within the product for you to make a choice of one thing over another. It's just, what do I think is going to deliver the best outcome for this client, given their particular, needs, disposition, psychology, et cetera. So I think, that's a huge advantage of no load just in general.
All right.
And go ahead.
No, yeah. So, and my colleague Roshan also had said, Erik, I think and this is, I think he was just sort of like, I think one of the criticisms I've heard is that there are certain ages beyond which it's now not useful to concern yourself with this. If you need to get on it a little earlier, maybe is the implication of this. But I think the way that he would structure this question is to say, is there an age beyond which, or a proximity to your life expectancy beyond which you've kind of missed that best window of opportunity, and now the argument in favor of this sort of a solution has really been diminished by just the passage of time?
Yeah, I mean, certainly when you're talking about income products, that would be the case. If you're, 80, and frankly, I mean, there are limits within products. I mean, insurance carriers won't let you write, an income product for 100-year-old person. I mean, it doesn't make any sense. So, once you get to, 80, 85 years old, the income products, don't necessarily, play as much of a role. Though it might, if you've got somebody with a particularly long life expectancy for whatever family history reasons, but that doesn't mean annuities don't work for that person, right? Because again, structurally, you're getting tax deferral and you're getting the benefit of accumulation. So you might not be looking for income, but you might still say, okay, fixed income market's pretty tough. MYGAs, which are multi-year guaranteed annuities, which is just like a CD. Except with tax deferral, might offer an attractive rate. And it's a 3-year product. It's a 4-year product. That could make complete sense for somebody who's even 85, 90 years old, to think about, something like that. And again, they're not losing their assets, they're not turning over their assets, like with a SPIA, or something like that. So it's just another investment product, that could make sense.
So for you and our listeners, I'll just mention that one of the things that we look at in trying to shape the asset allocation plan is to house the fastest growing things in their tax-free category if they have some Roth or through creation or conversion, their tax inefficient things in an IRA, and then their tax efficient leftovers in a taxable account. You've created, in this sense, you've sort of opened my thinking a little bit to say, okay, yeah, a MYGA for that portion of let's say the short-term bond component, that if you don't have enough room in the IRA to do that, you might do it in a MYGA and get essentially the same thing. Wait until they're at a point in time when they're a lower marginal income tax bracket, and then allow them to incur some taxation, all of that. So I appreciate your highlighting that.
Yeah, no worries. I mean, it's ordinary income, right? Ordinary income almost always makes sense to tax defer. That's one of the things at Jefferson National, the purpose of the product was to create a tax efficient mechanism. When I built that product, the notion was, okay, advisors who are managing money, you're doing it within a brokerage, taxable brokerage account by and large. Let's give you basically an unlimited tax deferred investment account, for $20 a month. Let's take advantage of tax deferral, locate your tax inefficient assets within the annuity, the tax efficient stuff within the brokerage account, just like you were just describing. So yeah, it makes, all kinds of sense to do that. The value, tax deferral, as I used to say all the time, when I spoke on tax deferral a lot, tax deferral is valuable. It's valuable to the tune of, done right, 2%, annually to a portfolio. But in the case of traditional annuities, if the annuity costs you 150 basis points just to own it, you've virtually killed the value of tax deferral. So again, the value of no load when you start looking at that. And the other, I'll just put this in quickly, the other application lots of advisors see and clients for MYGAs, again, the multi-year guaranteed annuity, is CD replacements. There are people who have lots and lots of money in CDs and assets in CDs, and they yield almost nothing today. Those are particularly inflation adjusted. You're just losing value in an annuity. I mean, in a CD. I'm sorry, where you can get similar safety, not the FDIC insurance, of course, but you can get very safe MYGA simple products with attractive rates. If you look at CD rates compared to MYGA rates, the MYGAs are paying significantly more.
So how is it
CDs.
that the annuity providers are able to do a higher rate than is possible for the banks? What leads to that outcome? I would be thinking they're dealing with the same underlying investment opportunities in the bond markets to support.
Yeah,
that.
Some of it's structural relative to how you can lever your assets as a financial institution. Some of it is, of course, overhead. Banks still have bank branches despite our best efforts.
All right.
So the banks still have very expensive overhead, and the assets. And don't forget, the assets that are primarily driving returns on the bank side are mortgages. Right. So mortgage rates are down dramatically. So their spreads, with their overhead are super tight. So there's not as much yield within mortgages as an insurance company who is managing, to the fixed income world. So, a great example I usually use for financial advisors is, that because insurance companies are among the best fixed income managers in the world. That's what they do. Allianz, who's one of the largest fixed income managers, insurance companies on the planet, PIMCO manages they own PIMCO, which is, one of the, largest, if not the largest fixed income manager on the mutual fund ETF side, is owned by Allianz, who manages Allianz's portfolio. So you're getting, kind of PIMCO, I probably can't say this regulatorily, but you're kind of getting a PIMCO managed portfolio, along with risk pooling when you're getting a product like from Allianz. So that's why insurance carriers can provide better yields on MYGAs than banks, because the primary asset for banks is going to be mortgages, and insurance companies can go in more places on the fixed income side.
Well, David, I'm going to ask Adrian in just a moment if he's got a last question. You had indicated you have a time constraint, and we want to be respectful of that. But how would people who want to follow you or get in touch with you, how would they do so?
Yeah, you can always call us. Numbers on the website, and I can't believe I don't know the 800 number offhand, but go to the website, DPLFP.com. We've got a tremendous amount of content on there, relative to annuities, a lot of education. We focus, a tremendous amount on education. We're revamping the whole website right now, introducing what we call DPL University or DPLU. It's going to have a lot of self-study classes, and designed for advisors and consumers, and access to our tools, which are super cool.
That's great. Yeah. So we'll also have that contact information in our show notes, David. So people can check there if they weren't able to catch a piece of paper and scratch it down.
I used to remember phone numbers, probably like most of us. Like I was terrific at it. Right now, I can barely remember my wife's number, because it's all programmed into your phone these days.
So true. So Adrian, did you have any last questions before we say goodbye?
I think we covered everything. I really enjoyed our discussion today, David. Again, thank you for being here. And I'm sure you really helped our listeners who just had more questions about annuities or considering annuities. You really kind of gave them a really good overview on what to start and what to look for. But Erik, I'll pass it over to you.
Okay. Well, listeners, thanks so much for sticking with us. I know, there's different persistencies during various episodes of our podcast, and I have a strong sense that we're going to have a deep persistence on this particular episode, and that's, David, entirely attributable to you. So thank you so much for joining us. We're really grateful, and I know our listeners will be grateful too. Listeners, if you do wonder how to find those show notes, then here's another web address for you to remember: retirementlifestyleshow.com. retirementlifestyleshow.com. Look, if you're listening to this very recently, it's going to be, or I should say shortly after our releasing this, it's going to be straight up there on the website. If you can't find it on the first 3 or 4 or 5 or whatever the display on the first page, go up to the tab at the top that says all episodes, and you should be able to find it. So, David, any sort of parting thoughts from you before we adjourn?
No, just, thanks so much for having me. I enjoyed the conversation. And, just for, people listening, this is a new world with annuities. I mean, you change everything when you take the commission out. Like I said, from the financial incentives to, recommending the products, to the cost. And these are valuable products. Don't let Ken Fisher sway you. Ken Fisher never could get paid on these assets. He had a very strong financial incentive to be anti-annuity. So, let's listen to the academics. We try to, do everything by academic study, here, and make our recommendations accordingly. So anyhow, again, thanks so much for having me. And it was really good to spend time.
Absolutely. All right, listeners. So thanks so much for joining us. Leave us a review. Tell your friends about us. And if you haven't subscribed yet, please do. This has been another episode of the Retirement Lifestyle Show.